What if I told you that possibly for the first time ever, we're getting estimates from executives themselves about how common accounting fraud is? And wait until you hear the new approach this research team took to find those elusive answers. We're joined by Alex Vandenberg, Assistant Professor of Accountancy at Gies College of Business. Alex, for years, researchers and regulators have been trying to figure out how common earnings manipulation is. And that's exactly what you're going after here. And the results are pretty interesting. You went straight to the source and asked almost 1,000 executives about earnings manipulations, getting potential first-hand accounts. You might imagine it'd be pretty hard to get executives to talk openly about this kind of thing. That's why you and your team used a really clever research design. But first, I want to define earnings manipulation for our listeners, and there were 5 kinds you looked at. Can you tell us what those are and what they mean?
Sure. So just at a high level, earnings manipulations occur when executives intentionally report misleading financial information in an attempt to secure some private or positive outcome for themselves or their company. And there are many different reasons as to why an executive might want to mislead through their financial statements. One reason could be that executives are close to meeting an earnings target that affects their annual bonus. Another reason could be that executives want to boost their stock price to keep their options in what we call in the money. Or it could just be simply that if executives don't boost their stock price, their job is on the line. At the end of the day, executives are trying to make their performance look better than what it really is. Okay, so now that we kind of have a general understanding of what earnings manipulations are, or at least why they occur, let's think about kind of what options executives have with respect to manipulating earnings. So an executive could cut expenses, and while this might be good in the short term for them, if executives are cutting important investments that benefit the company in the long term, things like research and development, those actions can be quite harmful. And so we call this type of behavior real earnings management, and involves a real decision that ultimately kind of presents the company more favorably than it really is. So then alternatively, executives might not actually cut real expenses. Instead, they could just kind of change some of the judgments or estimates that underlie the specific numbers that we see on the financial statements. We call this type of manipulation accrual earnings management. It most often happens around the squishier numbers in the financial statements. We're talking about things that require considerable judgment. And so while this on its face might seem like fraud, the financial reporting process involves a lot of subjective judgments. And with that, there's a wiggle room for executives to kind of manipulate or exploit that wiggle room to mislead investors. Another option that executives could take is that they take the numbers that they have as a given, and then they just try to hide or make it really difficult for investors to find the more unfavorable information. So they can either withhold it altogether, or they could bury it in the financial statements to just make it really difficult to understand. And so we examined those 2 types of manipulations as well. And then finally, we examined what is perhaps the most egregious form of earnings manipulation, and that is fraud.
So we're looking at everything from making operational decisions just to hit short-term earnings targets, even if it hurts the company in the long run, to burying bad news, to outright fraud, and everything in between. Some of it clearly illegal. Other parts legal, but not exactly ethical. And you use 2 different research methods here, a straight survey and a novel approach called a list experiment. What was the idea behind using both of these methods in the same study?
Unfortunately for us, it's just really difficult to study this because unless someone such as maybe an auditor or a regulator catches the manipulation and then reveals it to the public, the only people that would know that earnings have been manipulated are the executives who actually did it. And of course, these executives, they're trying to get away with it, presumably. And so if you just ask them directly, like, have you manipulated earnings? There's a very good chance that they might just lie about it if you were to ask them directly. And it's this conundrum is why we conducted a list experiment. We still wanted to go to the source and get the valuable information that executives have, but we wanted to give them an opportunity to respond truthfully without any risk that they could face consequences from doing so. And so a list experiment is an indirect questioning technique. And the innovation of this technique is that it allows executives to answer truthfully about their own misconduct while still maintaining a really high degree of plausible deniability. In fact, the plausible deniability of this technique is so high that it's impossible for anyone, including us, to know whether any individual executive admitted to manipulate earnings. But as researchers, we can use the overall results of the experiment itself to estimate on average the percentage of executives who admitted to manipulating their financial reports. And so although these indirect question techniques like list experiments are really useful when trying to get at sensitive topics where people have an incentive to lie about, in an ideal world, we would just be able to ask executives directly in a standard survey about their involvement in earnings manipulations. Now, in general, standard surveys are going to produce and more precise and accurate estimates if the participants provide truthful responses. This is the benefit of standard surveys. Again, it rests on the assumption that you're getting truthful responses, though. And I think prior to our study, most people just assumed that executives would never admit to earnings manipulations when asked directly because they face many consequences, could be illegal. Their job is online if they were to admit to these unethical behaviors. And it's this reason why I think no one has attempted prior to this study to ask executives directly in a standard survey about their involvement in earnings manipulations. And so with this background in mind, we thought it'd be worthwhile to complement our list experiment approach, which is designed to promote truthful responses, with a separate standard survey, which gets really precise estimates, assuming that the participants respond truthfully.
Okay, so in the survey, you just flat out ask executives whether their firm has engaged in any of the 5 forms of earnings manipulation in the past 5 years. What did that survey reveal?
Sure. So to our surprise, a staggeringly high number of executives just outright admitted to us directly that their firm has manipulated earnings. And specifically, we found that 27% of surveyed executives admit that their firm or company has manipulated earnings at least once in the past 5 years. All these executives, we find that 18% tell us that they changed an operational activity to meet a near-term earning target, but they did so at the expense of long-term shareholder value. So it's an overall damaging action that they took. We also find that 7% told us that they exploited the discretion allowed by the current accounting regulations to report earnings that misrepresent the true performance of the company. Another 9% told us that they intentionally obfuscated unfavorable information in their earnings reports. They could either just buried it on page 150, for example, or just made it really difficult to understand. Another 4% told us that they just withheld unfavorable information altogether from investors, even when they were supposed to give that information to investors. And now, perhaps unsurprisingly, we find that 0% told us directly that they admitted to fraud. And we think that makes a little bit sense because fraud is the one behavior that we look at where it's absolutely 100% illegal. And so it kind of makes sense to us that executives might have been a little bit willing to admit to the other less egregious behaviors, but they stopped short of telling us outright that they committed fraud.
So in the survey, a little more than a quarter, 27% of the executives admitted to some form of manipulation, but no one admitted to fraud. So next, you turn to the list experiment, and this is where the study gets really interesting. A list experiment is designed to promote more honest answers. And for those who have never heard this before, explain what a list experiment is and how you applied it in this study.
We start by splitting executives into 2 groups at random. We have a treatment group and a control group. The treatment group is going to receive a list of 5 different true-false statements about them and their company. The key part of this technique is that executives don't answer each individual true-false statement. Instead, they only tell us the total number of statements on the list that are true for them. And so this is important because one of the 5 statements will be about manipulating earnings. For example, and I'm paraphrasing here, one statement could be, my company committed fraud. The other 4 statements are going to be completely innocuous. Things like, for example, I generally work from home. And those statements are only there to protect executives' privacy. Now, because we only asked about the total number of statements that are true, not which specific statements are true, executives can admit to fraud. They can tell us that they've done so without having to definitively state exactly that they have committed fraud. So they would give them a chance to respond truthfully without any fear of repercussions for doing so. And so once we have that, we're going to have a bunch of executives who looked at a list of 5 statements and provided a single number 1 through 5. And that's going to represent the total number of statements in that list that are true for them. And then the control group is going to receive a similar set of statements, but it's only going to be 4. We're going to exclude the 1 statement about fraud. And so by comparing the average number of statements rated as true between the control group, who receives 4 innocuous statements, and the treatment group, who receives the same 4 innocuous statements, plus 1 additional statement about fraud or a different type of earnings manipulations, we can compare the difference in the average number of statements rated as true across those lists. And that's going to give us a good indication of how many executives responded affirmatively to the statement about the earnings manipulation.
So instead of having to answer directly to questions like they did in the survey, the executives were just presented with a list of statements and reported only the total number of statements in each list that applied to them. So what did you find using this approach?
Sure. So based on the results of our list experiment, we estimate that 12.4% of the Russell 3000 companies have committed financial statement fraud at least once in the past 5 years. What's really interesting to us about this estimate is that when we asked executives directly about fraud, exactly 0 of them admitted to it. However, when we asked executives indirectly within our list experiment, which again is an approach designed to promote truthful responses, that's the entire premise of it, executives' responses to us suggest that 12.4% of companies have recently committed fraud. So quite a big difference when you allow executives the chance to respond honestly with the privacy protections of plausible deniability.
So in the survey, 27% directly admitted that their firm had manipulated earnings, and nobody directly admitted to accounting fraud. But in the list experiment, which is specifically designed to elicit honest responses, you're suggesting the prevalence of fraud is closer to 12%. Based on these findings, what's the big takeaway here?
I think that one big takeaway is that our findings probably suggest that earnings manipulations are not really rare, and that the number of financial statement frauds that are being committed is probably quite a bit higher than the number that is being uncovered. I think that these findings probably underscore the need for investors to really maintain a skeptical eye when viewing the financial information presented by executives, because even audited financial statements could be manipulated, and those manipulations could go undetected by the people that are in charge of trying to detect those. I think our findings also highlight the importance of great auditors and regulators, those that are tasked with detecting and deterring this type of behavior. I think from a researcher standpoint, our findings also suggest that the prevailing assumption that executives won't admit to unethical behaviors when you ask them directly, that might not be as supported as I think we initially assumed. I think our findings show that, at least for the less egregious forms of earnings manipulations, there's a decent number of executives who are just willing to outright tell you that they've committed these unethical actions.
I think we'd all agree that transparency, accountability, and ethical behavior are key for a truly healthy market. Investors and regulators need this in order to build a system that actually prioritizes long-term value over short-term gains. And it's important research like this that hopefully gets us one step closer to that reality. That was Assistant Professor of Accountancy Alex Vandenberg. The paper is called Measuring the Prevalence of Earnings Manipulations, a Novel Approach. You can read more about this and other research from Gies College of Business at giesbusiness.illinois.edu.